While you were wrapping up holiday shopping and preparing for the new year, something extraordinary unfolded in global financial markets, something that didn't get nearly enough mainstream attention. The world's largest money managers executed what industry insiders are calling the Great Rebalancing. Over $1 trillion shifted positions in a matter of weeks. Vanguard, BlackRock, State Street, major pension funds, sovereign wealth funds, all moving simultaneously, all rotating out of their biggest winners, all going defensive at exactly the same time. The financial media labeled it routine year-end portfolio maintenance. Standard operating procedure, nothing to see here. That explanation is dangerously misleading. This wasn't routine housekeeping. This was a coordinated response to valuations that have become stretched beyond sustainable levels. When the smartest money in the world starts running for the exits together, that's not routine. That's a warning. Right now, early January 2026, these massive institutions are fundamentally repositioning for what they see coming. And here's what should grab your attention. Vanguard, managing $11 trillion in assets, just flipped their entire investment recommendation. For decades, the gold standard allocation was 60% stocks, 40% bonds, the 60-40 portfolio. Every financial advisor preached it. Every textbook taught it. Safe, boring, reliable. Vanguard just said flip it entirely. Go 40% stocks, 60% bonds. Their chief economist didn't call this a minor adjustment. He called it a tectonic shift. Those were his exact words. Tectonic shift. Think about what that means. The second largest asset manager on the planet is telling investors to be significantly more defensive, willing to sacrifice some return for substantial risk reduction. They're not doing this because they love bonds. They're doing this because they see danger ahead, danger serious enough to completely reverse decades of conventional wisdom. In the final 2 weeks of December 2025, institutional investors moved more than $1 trillion. They dumped tech stocks. The Magnificent Seven, Nvidia, Microsoft, Apple, Amazon, the companies everyone believes are bulletproof winners of the AI revolution. They sold them aggressively. Not because these companies are failing, not because AI is over, because valuations became so stretched that risk now outweighs reward. When the system faces stress, nothing is truly safe except genuinely defensive assets positioned for protection rather than growth. Let me show you the math that explains everything. Vanguard's projections indicate that over the next decade, a 40-60 portfolio will deliver about 5.7% annualized returns. Compare that to the traditional 60-40 approach at 5.3%, nearly identical returns. But here's the critical difference. The 40-60 allocation has expected volatility of 6.9%, the 60-40, 9.3%. You get essentially the same return with dramatically lower turbulence. Same gains, far less stomach-churning volatility. That risk-reward relationship tells you everything about where we are. The additional risk of holding more stocks isn't being compensated by higher returns. The market has repriced to the point where bonds offer similar outcomes with significantly less drama. When that happens, when taking more risk stops paying off appropriately, smart money adjusts immediately. Now let me explain why this matters beyond just portfolio theory. U.S. equity markets averaged 15% annual returns over the past decade. That's exceptional by historical standards. Vanguard's projecting 4.5 to 5% for the coming decade. That's a 70% reduction in expected returns. They're not being pessimistic. They're being mathematical. Valuations are already reflecting extremely optimistic assumptions. There's limited room for prices to expand further unless earnings growth dramatically exceeds already lofty expectations. On the bond side, something changed fundamentally. For 15 years after the 2008 crisis, bonds paid almost nothing. A 10-year treasury yielding 2% when inflation runs at 3% means you're actively losing purchasing power. Bonds were useless. But now, 10-year treasuries are yielding over 4%. Real yields after adjusting for expected inflation are solidly positive. Bonds finally offer actual compensation for the risks you're taking. They're back to being a legitimate alternative. This shift happened while most people weren't paying attention. Interest rates rose aggressively as the Fed fought inflation. Bond prices fell temporarily, but now rates have stabilized at levels that make fixed income genuinely attractive again. Vanguard's allocation includes substantial positions in international bonds. around 24% of the total portfolio. Why? Because central banks around the world are at different stages of their monetary policy cycles. Some have already cut aggressively. Others are pausing or might even tighten. That creates opportunities for yield and currency diversification that haven't existed in years. The institutional rebalancing in December wasn't just about portfolio targets. It was about recognition. Recognition that tech stock valuations have become detached from fundamental reality. NVIDIA briefly became a $5 trillion company. Think about that for a second. One company, valued at more than the entire GDP of most nations. The 7 largest tech stocks represent massive concentration in major indexes. When NVIDIA alone is 8% of the S&P 500, that creates enormous structural risk. Throughout November and December, firms like Goldman Sachs and Morgan Stanley advised clients to transition from AI innovators to AI adopters. Stop buying the companies building the infrastructure. Start buying the companies using AI to improve productivity and margins. That's a fundamental change in the narrative. It suggests the speculative phase has passed. We're entering an execution phase where actual results matter more than promising potential. The mechanical aspect of this rebalancing is fascinating. When stocks massively outperform bonds during a year, balanced portfolios become overweight in equities. To maintain target allocations, fund managers must sell winners and buy bonds. It's automatic, systematic, driven by algorithms and mandate requirements. But here's what's not automatic. They could have changed their target allocations. They could have decided to ride the momentum, increase equity exposure, chase the AI wave higher. They didn't. They deliberately chose to de-risk, position defensively, prepare for rougher conditions ahead. That decision wasn't made lightly. These are pension funds managing retirement money for millions of people, university endowments responsible for funding education, insurance companies holding reserves against future claims. They're the most conservative, risk-averse players in the entire financial system. When they simultaneously decide to get defensive, that's signal worth heeding. The timeline shows how dramatically sentiment shifted. After the market rebounded from April's tariff shock sell-off, tech stocks led an impressive rally through summer and fall. By October, optimism reached fever pitch. Then something changed. Volume patterns shifted. Smart money started exiting, not panicking, but methodically reducing exposure. By late December, the selling accelerated as year-end deadlines approached, and everyone rushed to complete rebalancing simultaneously. NVIDIA provides the perfect case study. The stock surged relentlessly through most of 2025. Then in the final weeks, despite solid fundamentals, share prices retreated as institutional holders trimmed positions. The company didn't weaken. The investment thesis didn't collapse. Valuations just reached levels where continued holding presented more risk than reward for fiduciaries managing other people's money. Microsoft, Apple, Amazon, similar stories across the board. These remain fantastic companies, industry leaders with strong balance sheets, growing revenues, dominant market positions. But at 40 or 50 times earnings, when historical averages are 15 to 20 times, you're paying for perfection. Any disappointment, any miss on lofty expectations results in substantial price declines. Risk managers couldn't justify maintaining such concentrated positions at such stretched valuations. Meanwhile, bonds became surprisingly attractive. Not exciting, not sexy, but attractive on a risk-adjusted basis. Corporate bonds offered reasonable yields. Treasury bonds provided safety. International fixed income added diversification. The bond market, written off as obsolete just 2 years ago, suddenly looked compelling compared to equities priced for perfection. This creates a fascinating dynamic for 2026. The January effect typically brings fresh capital back into markets as rebalancing completes and new money gets deployed. But what if institutions remain cautious? What if they keep higher bond allocations, maintain defensive positioning, refuse to chase stocks higher? That could create significant headwinds for equity markets even if economic fundamentals stay solid. Here's what Vanguard's recommendation really means in practical terms. If you're approaching retirement within 3 to 5 years, the 40-60 allocation makes tremendous sense. Lower volatility matters more than maximum returns when you're close to needing the money. Watching your portfolio swing wildly in your early 60s is nightmare fuel. Stability becomes paramount. The bond-heavy approach delivers that stability while still providing reasonable returns. If you're younger, with decades until retirement, the calculus changes. You can afford volatility. Time heals temporary losses. But even for young investors, current valuations suggest caution is warranted. Maybe not 40-60. Maybe 60-40 still makes sense, but perhaps with more attention to which stocks, more focus on valuation, more emphasis on quality and profitability, rather than pure growth speculation. The international component deserves special attention. Vanguard projects non-U.S. stocks will outperform American equities over the next decade. Their outlook for international developed markets is 5.1 to 7.1% annually, higher than U.S. projections. Why? Valuations are simply more reasonable abroad. European and Japanese stocks trade at significant discounts to American equivalents. The performance gap has room to close. But diversification goes beyond just seeking better returns. It's about not putting all eggs in one basket, especially when that basket has become extremely expensive. If U.S. stocks disappoint, having exposure to other markets provides cushion. If the dollar weakens, international holdings benefit from currency effects. If trade policies shift, geographic diversification reduces country-specific political risks. The small cap and value elements of Vanguard's recommended allocation also matter. These areas have underperformed growth stocks dramatically for years. They trade at historically cheap valuations relative to large-cap growth. If markets rotate towards style diversification, value and small cap could provide surprising upside while growth stocks consolidate or correct. It's positioning for regime change, preparing for a market environment where different factors drive returns than what worked over the past decade. Now, here's the critical question. Should you immediately sell all your tech stocks and buy bonds? Probably not. Timing the market precisely is nearly impossible. Today's seller becomes tomorrow's regretful observer if stocks continue rising. But should you understand what the smart money is doing and why? Absolutely. Should you evaluate whether your portfolio has become too concentrated in expensive momentum stocks? Definitely. Should you consider whether your risk level appropriately matches your timeline and goals? Without question, the beauty of Vanguard's 40-60 recommendation is that it's not market timing. It's valuation-aware asset allocation. They're not predicting a crash next Tuesday. They're saying that over the next 10 years, the risk-reward relationship favors more defensive positioning than traditional wisdom suggests. You're not trying to dodge a specific event. You're adjusting your long-term structure to reflect current market reality. This approach works especially well with regular rebalancing. If stocks decline and bonds hold up, you systematically sell bonds and buy stocks when they're cheap. If stocks surge and bonds lag, you take profits and rebalance back to target allocations. Disciplined rebalancing forces you to buy low and sell high automatically, removing emotion from the equation. The trillion-dollar rebalancing in December demonstrated one other critical lesson. Institutional investors follow rules and mandates mechanically. When portfolios drift away from targets, they correct regardless of sentiment or momentum. Individual investors often do the opposite. They chase what's working, hold losers hoping for recovery, make emotional decisions at the worst possible times. The institutions succeed partly because they remove emotion entirely. Cold, calculated, systematic adjustment based on predetermined rules. You can't control what markets do. You can't predict the next correction or rally. But you can control your positioning. You can decide whether your current allocation appropriately balances growth potential against risk tolerance and time horizon. You can evaluate whether you're concentrated in areas that have become expensive. You can ask whether you have enough defensive holdings to weather inevitable turbulence. Vanguard's tectonic shift in recommendation isn't about being bearish or pessimistic. It's about being prudent. It's about recognizing that when everything has gone right for a long time, valuations reflect those perfect conditions. And when valuations price in perfection, future returns typically disappoint, because perfection is hard to maintain indefinitely. The coming months will reveal whether this great rebalancing was prescient or premature. But regardless of short-term outcomes, the underlying logic remains sound. When bonds finally offer reasonable yields again after 15 years in the wilderness, they deserve consideration. When stock valuations reach levels historically associated with below-average future returns, caution is warranted. When the world's largest institutional investors simultaneously choose defense over offense, that signal carries weight. Here at Next Generation Finance, we track these macro shifts because they affect every investor. Understanding what the smart money is doing and why helps you make more informed decisions about your own situation. We're not telling you to panic or make drastic changes. We're showing you what trillion-dollar institutions concluded after extensive analysis. What you do with that information depends on your specific circumstances, goals, and risk tolerance. The takeaway isn't that stocks are doomed or bonds are guaranteed winners. The takeaway is that the risk-reward relationship has shifted materially. The tailwinds that pushed equities higher for a decade have weakened. The headwinds that made bonds unattractive have dissipated. In that environment, more balanced and defensive positioning makes sense for many investors, especially those closer to needing their money or uncomfortable with high volatility. Pay attention to what institutions are doing, not what they're saying. The $1 trillion they moved in December speaks louder than any press release or quarterly letter. When Vanguard flips their entire recommended allocation, that's not casual advice. That's their best assessment of risk and opportunity over the next 10 years, based on sophisticated modeling and decades of experience. You don't have to follow it exactly, but you should understand it thoroughly. This is not financial advice. Always do your own research and consult with qualified professionals before making investment decisions. If this analysis changed how you're thinking about your portfolio strategy for 2026, hit that subscribe button right now. The market environment is shifting in ways most people haven't noticed yet, and we're committed to keeping you ahead of the curve with data-driven analysis, not hype or fear. Drop a comment and tell me, are you adjusting your allocation based on current valuations, or are you staying the course regardless? Your strategy matters, and I want to hear what you're thinking.